As the title of the webinar says, it's musings. So musings is like my thinking. And what I'm hoping to do in today's session is trying to explain to you how I'm thinking about issues. So I've used an economist lens to look at issues. And hopefully, as our mission is economic literacy and advocacy, hopefully that I can leave with you something about how to think about some of these fiscal policy issues. So let me first start. So I need to explain some basics to you. At times, you might think it's a bit technical, but sometimes the elegance of some basic mathematical relationships cannot be taken away. And let me try to explain as best as I can. So, most of you probably are familiar with the concept of GDP, and there are three methods in which the gross domestic product, the word domestic means what is produced within the confines of Sri Lanka. So there's an income method. And if you look at the income method, what it tries to say is that of the production that happens, the benefits of that, who does it go to? So there are basically three constituencies: wages, which is the returns to labor. The PR is the profits, basically, what goes to the factors. So, interest and dividends and retained earnings. And then taxes, which goes to the government. There's another way to look at it, which is called the expenditure method. And that is showing how the resources were expensed. So the Y stands for GDP, and either it could be consumed, either it is invested, and consumption is either by the government or by the non-government sector, which are firms and households. Investment also can be from government, and what it can be from private and firms. The X stands for what is exported, and the M stands what is imported. The third method is what is called the production method, which is the accumulation of the different sectors. You have three main sectors: agriculture, industry, and services. So this is a tree diagram that kind of tries to show you, under the production approach, what accounts for GDP. We have a large amount of services, 61%. Industries, of which construction is a large component, because there's a manufacturing sector, and then construction and utilities. And then there is agriculture, which is about 8%. And then taxes are 7%. So there's a concept called gross value addition. So gross value addition plus taxes gives you GDP. And this is based on real GDP. What I'm trying to show is the expenditure approach and what components are contributing to GDP. So you can see that this is constant prices. So this is adjusted for inflation to see over a period of time. And what is visible here is in 2023, the output is significantly below 2018. And although we have posted a very strong third quarter GDP figure, we are still going to be below what we achieved in 2018. The recovery will probably take past 2015 to go back to where we came from. So consumption is a large component, and then investment and exports minus imports. It's a net negative figure. So we import more than we export. This is the income approach. So what labor share is actually a smaller component, and then what private firms have, and then you have this other sector, which, because we have a large informal sector, which they own, like small businesses, etc. So it's a combination of labor and capital that creates their surplus. So now to some economic relationships, and it's important that I go through this because there's a fundamental point I'm trying to explain to you. So what you see here is basically the expenditure method that I explained. So once again, consumption, which has both the government and outside government, which are households and firms. You have investment, which is both government and non-government. The majority of it is non-government. Exports minus imports. And the concept of savings, especially by the domestic sector, is your total income minus total consumption. So it's an easy concept to understand that you get X amount of income, what you consume, what balance is what you save. Economists have this concept called absorption, which is the total consumption plus investment. And if your total consumption plus investment basically is more than your GDP, it means that you need to bring savings from outside the country. Now, lots of people talk about the trade balance, which exports stands for the exports of goods and services. If it is only goods, that would be, excuse me, merchandise exports. But X minus M is the trade balance, which is the export of goods and services minus imports of goods and services. And if you take this equation where I'm pointing to and rearrange it, X minus M can be written as income minus consumption minus investment. And that is the same as this relationship, savings domestic, Y minus C minus I. So there is the concept of national savings. That means what is the savings that belong to your nationals as opposed to what is generated within your economy, because some of that savings may not belong to your nationals. It may belong to foreigners. And that adjustment, you take the domestic savings and you add what is called primary income. In our case, this primary income is negative because we have a lot of foreign borrowings. The indebtedness of Sri Lanka is something like 60%. So there's something called the international investment position, and it's quite high in Sri Lanka, 60% of GDP, which is a combination of profits that accrue to foreign investors and debt that accrues to foreign investors. Now, that debt is not only with government, there is also private sector debt. The equity component, of course, is mainly private equity, private sector. Then you have secondary income. And secondary income is net transfers. So basically, that is remittances that are coming into Sri Lanka, which will be around 7 billion this year. And we also have remittances that are going out of Sri Lanka. It used to be about 1 billion because there was a lot of Chinese workers working here, a lot of expatriates. So a lot of outflows are also there. And the concept of this current account balance, which is what drives balance of payments issues, is this trade balance, which is X minus M plus primary income plus secondary income. And mathematically, it is written like this. So what a current account balance is a savings investment gap. And the savings is at the national level. So the current account balance is the savings investment gap. Now you can take this and break it down into what is the savings investment gap from the government and what is coming from the private sector. So very simply, the current account balance is the savings investment gap of the government and the savings investment gap of the private sector. So the savings investment gap of the government is what you normally call the budget deficit. The technical term is overall balance. So that is basically the government's taxes minus what the government consumes minus what the government invests. So that's the savings investment balance of the government. And I have written it again, the savings of government minus investments made by the government. So finally, the current account balance can be looked at the overall balance from the fiscal plus the private sector savings investment. Just give me a second. So let me just get, I don't know what's happening. Okay. Can you go on here? Okay. So sorry, I had a small technical issue. So what drives the savings investment gap of government? Well, one is a revenue. So it will be dependent on the tax policy. It will also depend, the tax policy defines what are the areas that are going to be taxed at what rate. The tax buoyancy is highly correlated to economic growth. So when an economy is doing well, say economy grows by 5%, generally if you have tax buoyancy, the taxes should grow faster than the economy. And what explains that? Well, when economies grow, people have more income and they will spend it on discretionary items on which the tax intensity is much higher. There's also the case that when an economy is doing well, your variable income component will be higher. Bonus, perhaps some overtime, and that will get taxed at your highest marginal rate. So therefore, the tax collection of government is going to increase. And generally, firms also will make more profit if the economy is doing well, and therefore they will pay more taxes. Revenue is also dependent on tax administration, that whatever the tax policy says, that it is enforced. And then you'll also have revenue from non-tax sources. That also, if the economy is doing well, you'll probably be earning more non-tax revenue. Then how you spend it. So you can break it down to something called primary expenditure. And that is mainly recurrent expenditure without interest plus capital expenditure. And what drives that is the size of government. In Sri Lanka, it's fairly large. 15% of the labor force is employed in the public sector. The social welfare programs that you have, like subsidy transfers, we used to call it Samurti, now it's called Aswasuma. Capital expenditure, how much is being invested by the government, and what goods and services the government itself consumes. And then finally, the interest expenditure. In the case of Sri Lanka, it's very high, like one of the highest in the world. Like last year, it was 8% of GDP. Maybe it will come down slightly this year because there might be a little bit more nominal growth. That's dependent on the size of the government's debt, what's called the gross financing needs. So how much of the debt has to be rolled over in any given year. And if you are running a primary balance deficit, then you have to finance that in addition to the maturity of the debt and paying the interest. Now, the issue that Sri Lanka has is that we have to reprofile our debt. We have to issue longer dated securities. And since our yield curve is massively upwardly sloping, there's about a term premium of about 250 basis points. Most countries, it's less than 100 basis points. But because we don't have a lot of buyers at the longer end of the market, it is costing the government a lot because we have to issue longer dated securities, which have to be issued at a significant term premium. The monetary policy will determine the prevailing interest rates, and the exchange rate also will play a role because some of that debt that you have is borrowed from overseas.